Welcome to video 23B on the state tax base. So we're starting our progress through solving our question. So we've made it through what states get to tax coal-bearing nations income. Well, it's those that have substantial nexus. Now we need to work on how much do they get to tax. Okay, so let's start with an example here of Company Z, who's headquartered in State A and has nexus in State A and State B, and the following forms of taxable income and deductions. So they've got some sales revenue, some cost of goods sold, some selling general and administrative expenses, some depreciation, some interest income, income from a rental property, and interest expense. And one of the next steps we have to do in order to decide how much each state gets is we need to recalculate taxable income under that state's rules. So kind of so far, all we've been focused on is calculating taxable income under the federal rules. Well, it should come as no surprise that each state often tweaks those federal rules to what it deems fit and appropriate for its particular state. Now, some states just follow along and do exactly what the federal calculation is, but most do not. And California in particular is a state that deviates quite a bit from the federal rules. So in order to do that, there are a couple things that usually you need to think about. Like, for example, what is the proper amount of depreciation, right? We know that depreciation is prescribed using tables, et cetera, et cetera, et cetera. That's true for federal purposes, but the states don't always follow that same rule. They may not apply Section 179. They may not have bonus depreciation. What about rules like charitable contributions or net operating losses? So do you get a charitable contribution if you make it in a state other than the state in which is examining you? Or do you get an NOL associated with your overall federal NOL? Or do you calculate one on a state-by-state basis? So state laws can be similar to federal tax. So a lot of times the calculations are close. As a result, the common technique that you see to calculate state income taxes, even though we're not really going to follow that here for the example purposes, is you start with federal income and then you adjust it. So for example, if federal depreciation is $900, but calculated under state A rules it would only be $600, then you take federal taxable income and increase that income by $300 to reflect the elimination of federal depreciation and the inclusion of state A depreciation. Okay, so here's a list from the book of common federal to state adjustments. So these are items, again, what we're doing is we're not isolating yet for how much income belongs to a state. We're simply recalculating, I like to think of it as worldwide income. Now, sometimes it's just U.S. income. But worldwide income on the rules under that particular state. Okay, so that implies that, of course, we need to do a separate calculation for each state, which is true. Typically, that would be done. Each state tax return needs to be done separately anyway. So you end up doing a calculation for each state under its rules. So let's say in our example, depreciation is $600 for state A and $500 for state B. We've got some interest income, and it's from U.S. Treasury bills. And we have some additional income of $200 on municipal bonds that, of course, is not included in federal taxable income because it's not taxable federally, but it may be taxable at the state level. So what we do is we recalculate that total taxable income for state A and state B separately. So you can see that on the depreciation line, we've substituted in the state depreciation numbers for the federal depreciation numbers. We see that the interest income, since it's from U.S. Treasury bills, since it's not legal for a state to tax U.S. Treasury, U.S. government obligations, as a result, there's no taxability of that income and it's excluded. The interest expense is fine, and then we added back the municipal bond interest because those are from state A. State B taxes them, but state A does not tax them. So under their rules, that's non-taxable. Under state B's rules, that would be taxable. Okay, so we call that the state base, and there's no real reason to call it state base other than that seems to be what everyone calls it. But it represents, again, the worldwide income calculated based on a particular state's rules. Okay, so does the state base represent taxable income? Well, absolutely not, right? So again, we know that's worldwide income. Now we need to take each state's base, so the state base amount, and divvy it up. We need to divvy it up amongst all the states. There are two methods by which that is done. One is called allocation, and the next is called apportionment. And the good news is that's the next video, which means that brings us to the end of video 23B. Thanks for watching. We'll see you in the next video.